Hi, I'm Cindy David, co-author of the book Financial First Aid for Canadian Investors. I've been a financial planner for 15 years. I'm going to talk to you about saving money on life insurance. In my experience, I do find that most Canadians own the right amount of insurance, but not the right type. So we're going to talk about what type of insurance to buy to save you some insurance premiums. Before you reach retirement, there are certain risks that exist. If you're married and you've just bought your house for the first time, you have a mortgage. That's a financial risk. If one of you passes and the survivor cannot afford those mortgage payments, we definitely want to start there. The other risk is, if you're married and you have a family, the risk of losing a breadwinner is a major financial risk. So we want to add that into how much insurance we should own. But all of these risks that I'm talking about so far are temporary risks. Not many people get to retirement and still have a mortgage. When you get to retirement, that means that you've saved enough money in the nest egg to fund all of your retirement living needs. So there's no more risk of loss of that income. Anytime we have an insurance need that is only going to be there for a short period of time, we don't need it forever, we use term insurance to solve that. And term insurance is fairly inexpensive if you're a non-smoker and in good health. Other needs for that term insurance are paying for kids' education, or even paying for caretakers for younger kids if you have a surviving spouse that must continue to work in the workforce to maintain lifestyle. Insurance is after tax, don't forget. The death benefit is tax-free, so we only need to insure the after-tax income that you're earning, because you don't get to spend or save your taxes. So that also reduces the amount of insurance that you need. Once you get to the right amount, then you just have to figure out, how long is this risk going to exist? If I have done a financial plan and I know that my retirement target is in 10 years from now, I'm going to buy a 10-year term insurance plan to solve that need, because I'm going to cancel it in 10 years when I no longer have these risks to worry about. The only time we should be talking about permanent insurance, and this is something that I find on a regular basis, we have too many people out there that have permanent insurance on their individual lives that are there to protect these short-term risks. When we use permanent insurances is quite often only when we talk about estate planning or using those plans to invest as a tax shelter. When we talk about estate planning, the taxes that are due are often not due until the second death, because we have spousal rollover provisions on most things. Non-registered investment accounts are owned jointly, quite often between spouses. We can name our spouse as the beneficiary on our RSPs and tax-free savings accounts, and our houses are usually jointly owned. That means that everything will roll over to the surviving spouse on a tax-free basis. It isn't until the second spouse dies that all of the estate taxes kick in. This way, we can use a really affordable insurance plan to solve the estate tax problem. We can put two lives under one insurance plan, a permanent insurance plan. This reduces the risk to the insurance company because they don't have to pay out the death benefit until both lives are gone. When we reduce the risk to an insurance company, it cuts your cost in half. And the timing matches. Tax bill comes due when the second person dies, and that's when the insurance payout happens. So we want to make sure that you're talking to your advisors about what type of insurance, not only how much insurance you should have, but making sure that it's the right kind. Don't forget, buying insurance is like shopping at Costco. The more you buy, the less you pay per can of tuna. So consolidating your plans might be another way that you could save some money.